In Florida, a retiree named Parks Huffstetler opened a letter that changed everything. He'd bought his condo at Surfside Club South a few years earlier, expecting a quiet retirement near the water. The letter said he now owed over $100,000, a one-time bill tied to structural repairs his building had never saved for. He had no idea it was coming. Here's what most buyers believe. They believe a home inspection catches the problems that matter. It does not. The inspection checks the house. It does not check the ownership structure, the association's finances, or whether the property even has a legal right to its own driveway. So here's the real question. If the inspection you're counting on can't see these risks, what actually protects you before you sign? There's a pattern behind every one of these failures, and it traces back to something that happened long before the seller ever listed the home. That's what this video is about. Skip it, and you can do everything right, pass every inspection, and still inherit a six-figure problem that was never yours to begin with. My name is Alex, and if you've ever signed closing papers and felt a flicker of doubt you couldn't quite explain, stick around, because that doubt is usually your instincts catching something your paperwork missed. I'm going to show you the 5 property types I would never buy as a real estate attorney, and the exact questions that expose each one before you're locked into a contract. Once you understand what these documents are hiding, you'll read every listing differently. The first one starts with a word most buyers never think to ask about: access. Number 1, landlocked property. Here's a question that never crosses most people's minds until it's too late. Can you actually get to your own house? That sounds absurd. Of course you can get to your house. You drive up the road, you turn into the driveway. You're home. But what if there is no road that's legally yours to use? What if the only way in is a gravel path across someone else's land, and that someone else decides tomorrow they don't want you crossing it anymore? This is what landlocked property means. Your parcel has no recorded legal access to a public road. None. You are boxed in on every side by land that belongs to other people. And here's the myth I hear constantly. People tell me, I read online that the government has to give you access if you're landlocked. That is not true. The government has nothing to do with it. Access is a private property right. Your neighbors are not required to let you cross their land just because you need to. Let me tell you about a buyer I'll call Dana Whitfield. Dana was a pediatric nurse in her early 50s, looking to retire early on 12 acres outside Asheville, North Carolina. The listing photos were stunning. A creek, a ridge-line view, total privacy. What the listing didn't mention was that the only path to the property crossed a neighbor's cattle farm, and that crossing was never recorded anywhere. Dana closed on the land before hiring an attorney to review the title. 6 months later, the neighbor put up a locked gate. Now, there is a legal option here. It's called an easement by necessity. A court can grant you access if your land was once part of a larger tract that got divided in a way that cut off your route to the road. Dana technically had a case. Her 12 acres had been split off from a 200-acre farm back in the 1970s. But here's the part that surprises people. Having a valid legal argument does not mean you get a fast resolution. It means you go to court to prove it. Dana spent 18 months in litigation and paid her attorney over $30,000 before the judge ruled in her favor. Contrast that with what she thought she was buying: a quiet retirement property, not a lawsuit. And that's the trade you're actually making when you skip this check. It's not just about the money, though $30,000 is real money to lose on top of a purchase. It's the time, the stress, the uncertainty of not knowing for a year and a half whether you'll ever legally reach your own front door. So here's what I tell every client now. Whether they're buying 12 acres in the mountains or a $5 million estate in Aspen, Colorado. Before you make an offer, pull the deed. Pull the recorded plat. Look for the words legal access or an easement specifically granted to your parcel. If you don't see it in black and white, that's not a detail to sort out later. That's a reason to walk away, or at minimum, to make your offer contingent on confirming access first. Because here's the thing about landlocked property. The seller already knows if there's a problem. They just aren't required to volunteer it unless you ask the right question. And access to the land is only step 1. Once you're sure you can legally reach the property, the next question is whether what's sitting on it actually qualifies as real estate in the eyes of a lender at all. Number 2, mobile home with an uncanceled title. Here's something that surprises almost every buyer the first time they hear it. A house can sit on land, have a foundation, have a mailing address, and still legally be considered the same category of property as a car. That sounds strange, but stick with me, because this one trips up more people than almost anything else on this list. And it rarely shows up until it's too late to back out easily. When a manufactured home is placed on a piece of land, it doesn't automatically become real estate. It starts out as personal property, the exact same legal classification as a car or a boat. It comes with a title from the state, not a deed. For that home to actually count as real property, meaning legally attached to the land and part of the real estate itself, that title has to be formally canceled, and the home has to be properly and permanently affixed to the ground. If nobody ever did that paperwork, the home is still, on paper, personal property, and personal property doesn't qualify for a traditional mortgage. Let me walk you through what this looked like for a client I'll call Renata Kowalski, a high school guidance counselor who found what she thought was the perfect retirement setup outside Boise, Idaho. A manufactured home on 2 acres, fully renovated, gorgeous mountain views. She made an offer, got a lender lined up, and started the process like any normal purchase. Then, 3 weeks before closing, her lender came back with a problem. The title on that home had never been canceled. As far as the state was concerned, it was still a mobile unit, not real estate. Why does this matter so much? Because Fannie Mae and Freddie Mac, the 2 entities that back the vast majority of conventional mortgages in this country, will not purchase a loan on a manufactured home that's still classified as personal property. That means no conventional 30-year mortgage, which right now is averaging somewhere around 6.7 to 6.9% nationally. No FHA loan built for real estate either. Renata's lender could only offer her a personal property loan instead, similar to a car loan, with a shorter term and a noticeably higher rate. Here's the part that really gets me. The seller had lived in that home for 11 years. Nobody ever told him the title needed to be canceled when he set the home permanently on the land. He wasn't hiding anything on purpose. He genuinely didn't know. And that's exactly why you can't assume the seller will flag this for you. They might not even know there's anything to flag. So what do you actually do with this? Renata had 2 options: walk away from the deal entirely, or push the seller to complete the title cancellation and affixation process before closing, which took almost 10 weeks and required an attorney to sort out with the county. She chose to wait it out, and in the end, it worked out for her. Not everyone has that kind of patience or that kind of timeline flexibility. If you're looking at any manufactured or mobile home, whether it's a modest place in rural Idaho or a custom build worth $500,000, ask this question before you write an offer. Has the DMV or state title been officially canceled? And has the home been legally converted to real property? 1 sentence, 1 question. And it can save you months of delay, a weaker loan, or a deal that falls apart right before the finish line. Because owning the land is one thing. What happens when the person next door decides they own part of it too? Number 3, home with a known neighbor dispute. Imagine buying your dream home, moving in, unpacking every box, and only then finding out you also inherited someone else's decade-long grudge. That's not an exaggeration. It happens more than you'd think. And it happens because buyers make one very understandable, very costly assumption. They assume that once they own the house, old conflicts disappear with the previous owner. They don't. If a seller discloses that there's an active dispute with a neighbor over a fence line, over an easement, over where one yard ends and the other begins, do not assume that problem resets when you take the keys. You are not getting a fresh start. You are stepping directly into whatever tension already exists between those 2 properties, and it follows you the same way the address does. Let me tell you about a client I'll call Wesley Trammell, an orthopedic surgeon who bought a beautiful home on a half-acre lot outside Nashville, Tennessee. During disclosures, the seller mentioned, almost in passing, an ongoing disagreement with the neighbor about a shared driveway easement. Wesley figured it was minor. Neighbors disagree about things all the time, right? He closed on the house without digging any deeper. Within 4 months, that minor disagreement turned into a lawsuit, and Wesley was the one named in it, because the dispute wasn't really about the neighbors' personalities. It was about who legally had the right to use 6 feet of shared pavement. That's not something friendliness fixes. That's a property right, and property rights get settled in court, not over a fence with a wave and a smile. Here's what I want you to really sit with. A lot of buyers hear neighbor dispute and picture something petty, Loud music, an ugly fence, a dog that barks too much. Sometimes that's all it is, and it truly does fade once new owners move in. But when the dispute is rooted in something legal, a boundary line, an access right, an encroachment, it's a different animal entirely. Being a nice, easygoing person does not make a legal claim go away. Only a resolution does, whether that's a negotiated agreement or a judge's order. I've had clients tell me we'll just be friendly with them and smooth it over. Sometimes that genuinely works, but when real ownership rights are on the line, optimism is not a strategy. Wesley ended up spending close to $20,000 in legal fees over the next year on a home he'd paid just under $900,000 for. That dispute was never priced into his decision because he never asked the right questions before he made an offer. So if a seller discloses a neighbor dispute, and remember, in most states, they're legally required to disclose known disputes, treat that as a flashing red light, not a footnote. Find out exactly what the disagreement is about. Ask how long it's been going on. Ask whether any attorney has been involved, or whether anything has been filed with the county or in court. Then, and only then, decide whether you actually want to buy into that fight. Because here's the uncomfortable truth. You're not just buying square footage and a yard. You're buying every unresolved relationship attached to that property line. And speaking of things attached to a property that can quietly wreck its value, there's one more structure worth checking before you fall in love with the view. Number 4. Lakefront home with an unpermitted pier. What if the one feature that justified the entire price of your house wasn't actually yours to keep? That's the situation buyers run into more often than you'd expect with lakefront property, and it usually doesn't show up until they've already fallen in love with the view. Here's the setup. On a lot of managed lakes across the country, Lake Norman in North Carolina is a good example, where the lake itself is owned and regulated by Duke Energy, the pier or dock is not automatically part of the home. It requires its own separate permit, and that permit is a much bigger deal than people realize. Because on lakefront property, the pier isn't a bonus feature. It's often the entire reason the price tag is what it is. Let me tell you about a client I'll call Bianca Odom, a dental practice owner who bought a home on Lake Norman for just under $1.4 million. The listing photos featured her future dock prominently, a covered slip built for a boat like a Malibu wake setter. That dock was a huge part of why she paid what she paid. What nobody checked before closing was whether that dock had ever been properly permitted through Duke Energy Lake Services. It hadn't. The previous owner built it himself, years earlier, without ever filing the paperwork. And once Bianca owned the home, that became her problem, not his. Here's why this matters so much. When a pier is unpermitted, the managing authority, whether that's a utility company like Duke Energy, a state agency, or the Army Corps of Engineers on a federally managed lake, like Lake Travis outside Austin, can require it to be torn down, not modified, not fixed, removed completely. And there's no guarantee you'll be allowed to rebuild it the way it was. Bianca ended up in exactly that spot. She had to hire an engineer, submit a retroactive permit application, and wait almost 5 months for approval, all while paying a mortgage on a lakefront home with no working dock. In the end, she got lucky. The permit was approved, and she was able to rebuild. But she told me afterward that those 5 months felt like watching money sit at the bottom of the lake, doing nothing. I've seen it go the other way too, where the permit gets denied, and the owner is left with a home that has lake access, but no way to actually put a boat in the water. Suddenly, the property you paid a premium for isn't offering the lifestyle you thought you were buying. That's not a small disappointment. That's a real hit to the home's value, because the next buyer is going to notice the missing dock just as fast as you did. So before you close on any lakefront property with a pier or a dock, ask for the documentation, not a verbal assurance from the seller, not, "It's always been there," actual proof that it was permitted. If the seller can't produce it, that's not a minor gap to fix after closing. That's a serious problem to resolve, in writing, before you sign anything. Because a beautiful view doesn't come with paperwork attached. You have to go find that paperwork yourself, and if it doesn't exist, the view might be the only part of the deal you actually get to keep. Water access is one kind of shared resource that can turn into a legal headache. But there's a different kind of shared ownership, the kind hiding in plain sight behind a monthly fee, that's causing far bigger problems for buyers across the country right now. Number 5, condo or townhouse with a defunct owners association. What if the scariest number in your entire home purchase wasn't the price on the listing, but a number nobody shows you until after you've already moved in. That's exactly what's happening to condo owners across Florida right now. And honestly, it's the clearest example I've ever seen of a problem that was sitting there the whole time, quietly getting worse, while nobody said a word. When you buy a condo or a townhouse, you're not just buying your unit, you're buying into a shared ownership structure. The roof, the parking garage, the pool, the exterior walls, the elevators, all of it is maintained collectively through the owners' association. And if that association has been underfunding its reserves, meaning the savings account set aside for major repairs, you are buying into a debt that hasn't been billed yet. Let me tell you what this looked like for a client I'll call Camille Aduba, a hospital administrator who bought a 2-bedroom unit at a building similar to the cricket club in North Miami, a bayfront tower built back in 1975. She paid $410,000 for her unit, and the monthly association dues seemed reasonable. What she didn't know was that the building's reserves for structural repairs had been underfunded for years. Here's why that mattered so much this year specifically. After the Surfside condo collapse in 2021, Florida passed a law requiring buildings 3 stories or taller to complete structural inspections and fully fund reserves for major components, things like the roof, load-bearing walls, and waterproofing. Associations can no longer vote to skip saving for these. That law's funding requirements kicked in at the start of this year, and buildings that spent decades underfunding their reserves suddenly had nowhere left to hide. At the cricket club, that reckoning came out to a $30 million assessment, roughly $134,000 per unit. At another building, the Palm Bay Yacht Club, it reached $175,000 per unit. At Mediterranean Village in Aventura, some owners were billed up to $400,000 each. Let that sit for a second. $400,000 on top of what they already paid to own the unit. Camille's building wasn't quite that extreme, but her special assessment still came to $52,000, due within 18 months. She hadn't budgeted for that. Nobody had, because nobody told her to look for it. And I want to be clear, this isn't only a Florida story. Florida just made it illegal to keep hiding the problem. Underfunded reserves exist in aging HOAs and condo buildings all over the country. In Chicago, high-rises, in beachfront communities in San Diego. Anywhere a board has spent years choosing lower dues over honest savings, Florida's law just forces the bill due date into the open. So before you buy any condo or townhouse, whether it's a starter unit or a $5 million penthouse on Brickell Avenue, request the association's financial statements. Look specifically at the reserve fund balance. Ask directly whether there are any pending or anticipated special assessments. And get that answer in writing, not just a verbal reassurance from the listing agent. Because an underfunded association isn't a small administrative detail. It's a structural problem sitting inside the investment you're about to make, and it doesn't show up on the walkthrough. It shows up 18 months later, in the mail. And speaking of things that can quietly change after you've already signed, there's one more risk that has nothing to do with the building itself, and everything to do with whether anyone will still agree to insure it. A home your insurer can drop the day after closing. Here's a question most buyers never ask, because it never occurs to them that the answer could change. Will your insurance company still want to insure this house next year? You'd assume that if a home has insurance today, it's a settled matter. It is not. Homeowners insurance gets underwritten property by property, which means a policy that exists at closing can vanish at the very next renewal, and there is nothing in a standard purchase contract that protects you from that. Let me tell you about a client I'll call Holden Pruitt, a freelance architect who bought a home in the Pacific Palisades neighborhood of Los Angeles a few years back. He paid just under $4 million for it, a beautiful property with canyon views. At the time, his insurance was in place, and everything looked fine on paper. What he didn't fully register was that major insurers had already been pulling back from that exact area for years, citing wildfire risk, and quietly declining to renew policies on homes just like his. Then, in January of 2025, the Palisades fire tore through the neighborhood and destroyed thousands of homes. Some of Holden's neighbors discovered, in the worst possible moment, that their private insurance had already been dropped months earlier, and all that stood between them and total loss was California's FAIR Plan, the state's insurer of last resort. The FAIR Plan exists for exactly this situation, but it was never designed to fully replace a private policy. Coverage limits are lower, and it costs more for less protection. Holden happened to still have his private policy active. He was fortunate, but he told me afterward that the whole experience changed how he thinks about buying property entirely. He said the price of the house used to feel like the number that mattered most. Now he thinks the insurance policy is the real asset, because without it, the house is just a very expensive pile of exposure. And this isn't unique to California. Florida has its own version of the FAIR plan called Citizens Property Insurance Corporation, and it now covers hundreds of thousands of homes that private insurers have simply refused to write policies for. If you're buying anywhere near a coastline, a wildfire zone, or frankly, any part of the country that's seen major weather losses recently, this applies to you, whether you're closing on a modest bungalow or a beachfront estate. So here's what I tell clients now, and I think every buyer over 40 should be asking this before they fall in love with a listing. Before you close, don't just confirm that insurance is available today. Pull the property's clue report. That's the claim's history tied to the home itself. And ask the insurer directly whether they've non-renewed similar properties nearby in the last 3 years. If the honest answer is yes, that tells you something the listing photos never will. Because here's the pattern running underneath every single one of these 6 situations. The problem was never something that happened to you. It was something that was already sitting there, quietly, long before you ever walked through the front door. The only real defense isn't luck. It's knowing exactly where to look before you sign. The house was never the risk. What you didn't ask was, none of these 6 homes were bad houses. That's the part worth sitting with. The access problem, the uncanceled title, the neighbor dispute, the unpermitted dock, the underfunded reserves, the insurance that quietly disappears. Every one of them existed before the buyer ever showed up, and every one of them survived the closing table completely intact. Buying the house didn't make the problem go away. It just made the problem yours. So here's what I want you to actually carry with you. Access is a right, not an assumption. A title determines what a lender will touch. A dispute doesn't end because you're new. A permit is proof, not a story someone tells you. A reserve fund is either honest or it's a bill with your name on it, just not yet. And insurance isn't permanent. It's a decision someone else makes every single year. Next time you walk through a listing you love, ask yourself what isn't in the photos. That question will save you more money than any negotiation tactic ever will. If this changed how you'll look at your next purchase, tell me which one surprised you most. Share it with someone about to buy, and I'll see you in the next one, where we go through exactly what to check before you ever make an offer.